I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest results from finance company heavyweight Marac, which has improved its profit and is looking for other funding to continue growing. We'll also look at the details of BNZ's new Perpetual Tier 1 share issue, which it hopes to raise $700 million, and explore what it means for yield investors. But firstly, we dig around inside the results from finance company Marac. It says it's close to securing a multi-bank lending facility that will be bigger and include more banks than its current $400 million facility. Marac's managing director Brian Jolliffe says he's confident about continued lending growth despite a fall in depositors' funds. That's because Marac is backed by diverse funding sources. Unlike some other smaller finance companies, Marac has kept its debenture and reinvestment rates between 65% and 75%, and it's also secured funding from wholesale markets through a securitization program for $300 million. Marac has an investment-grade BBB- rating from Standard & Poor's. Jolliffe told interest.co.nz the new, bigger facility was another sign of its strength compared to the rest of the industry. He's pointing to Marac's publishing of its arrears figures for loans more than 5 days overdue as a sign of its relative strength. Marac's loans arrears stood at 0.48% of total loans at the end of December. That's actually down from a year earlier. He says there's no evidence at the moment that Marac's credit quality is deteriorating. He says there has been a slowdown in new retail funds coming in, which has dragged Marac's retail deposits down to around $600 million from just over $700 million a year ago. Marac's move to increase its bank facility and look at other wholesale funding options should allow it to continue to grow lending, says Jolliffe. Finance company collapses elsewhere mean there's plenty of choice for the lenders that remain. Now for a look at the Bank of New Zealand's Perpetual share issue to raise up to $700 million. Now this is interesting because it is likely to unleash a swathe of these pseudo-bond issues from the banks, with interest rates of over 10%. This will make life very difficult for finance companies who will have inferior credit ratings and interest rates that aren't that much higher. The BNZ's offer will be accredited as a Portfolio Investment Entity, or a PI, and have an A+ credit rating. It should be popular with investors who want a high yield with an investment-grade credit rating and who want to use the PI status to minimise their tax payments. ANZ National is expected to announce a similar issue within a couple of weeks, and Westpac is also thought to be preparing an issue. The interest rate on the BNZ share issue will be reset every 5 years. The BNZ issue will follow similarly large and potentially liquid issues on the NZDX last year from Rabobank and Credit Agricole. The BNZ has the right to suspend interest payments or dividends on the shares, but the rules are that any suspension of dividends from BNZ would also force the suspension of dividends from BNZ to the National Australia Bank, so that seems very unlikely. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Thursday.